Drenard Trust here. Let's talk about some growth stocks that you're gonna want to sell right now with a sense of urgency, right? But before I do that, take a moment right now to hit that subscribe button and the like button. I appreciate you. So let's talk about Palantir Technologies, right? It basically has an extreme overvaluation relative to its peers as of right now. So Palantir's valuation metrics are far above the industry norms. The stock trades at a forward price to earnings, the PE ratio of basically 191.27 compared to an industry average of 36.89, and a forward price to sales, that's the PS ratio, of 66.79 versus an industry benchmark of, about around 5, right? 533. Some sources report even, when I said 5, I mean 5.33, right? So some sources report even higher multiples, such as 594 times earnings and 109 times sales, or a price to sales multiple of over 100, right? Around there. This premium, pricing suggests that the stock is significantly overvalued, which historically increases the risk of a sharp correction if growth expectations are not met. There's slowing revenue growth. So while Palantir, has posted impressive recent growth at about 39% year over year in Q1 2025, its own guidance and Wall Street estimates point to a deceleration, with full year 2025 revenue growth expected around 36%, and consensus estimates signaling a further slowdown in 2026. So as the market has already priced in extraordinary growth, any slowdown could trigger a negative reaction and drive the stock price even lower. There's high expectations and risk of disappointment, right? At its current valuation, Palantir is priced for near perfection. Any operational misstep, missed earnings, or downward revision in guidance could result in a dramatic sell-off. Some analysts warn that a 50% drop in share price within a year would not be surprising given how stretched the valuation is. There's also uncertainty about the total addressable market. So there is a significant uncertainty about how large Palantir's market can ultimately become. Its focus on government and select commercial clients, primarily in the West, may cap at, basically TAM. If investor perceptions of Palantir's future market size shift, the stock could see severe downward corrections. There's competitive and structural risks. So the AI software sector is evolving rapidly, and barriers to entry may fall as AI models become commoditized, right? And the cost of AI, inference drops. So this could erode Palantir's competitive edge over time. Additionally, there's, Palantir's dual class share structure limits shareholder influence and could lead to management pursuing risky or non-core investments. There are alternative opportunities as well, right? Leading analyst teams, such as the Motley Fool Stock Advisor, have notably excluded Palantir from their list of top stocks to future returns, suggesting there may be a better risk-adjusted opportunities elsewhere. Other tech stocks with strong growth and reasonable valuations are available, so that's what it is. The second stock is, is basically has, again, premium valuation relative to its peers. That's the Robinhood, right? Which is currently trading at a price to earnings ratio of around 42, and a recent data show it has traded as high as 59.3 times forward earnings, substantially above the sector median of about 10.8 by 361, right? This high valuation means much of the expected growth is already priced in, increasing the risk of a sharp correction if growth slows or expectations are not met. The S&P 500 exclusion dampens the momentum, right? There is significant market anticipation that Robinhood would be added to the S&P 500 index, which typically brings increased demand and liquidity. However, the company was not included in the latest rebalancing, leading to a notable price drop and potentially curbing near-term investor enthusiasm. So this exclusion may also limit the stock's upside in the short term, as index funds will not be required to buy shares. There's extreme volatility as well. Robinhood stock is highly volatile, with over 54 moves greater than 5% in the past year. Such volatility can be unsettling for investors seeking stability, and it increases the risk of sharp, unexpected declines. There's overextension after massive run-up too. So the hood has surged over 200% in the last year, far outperforming the broader market. While this momentum is impressive, it basically raises concerns of overextension, especially since the stock is now only a few percent off its all-time high. Historically, such rapid gains often lead to pullbacks as early as investors, take profits. Regulatory and integration risk, right? Robinhood is aggressively expanding into new markets, including crypto and international financial services, through acquisitions like Bitstamp and Wonder5. So while these moves offer growth potential, they also bring regulatory uncertainty and integration risk. Increased regulation, particularly in crypto, that could restrict growth or increase compliance costs, negatively impact profitability. And there's profitability and growth. Speaking of that, right? It may not justify the price. Although Robinhood, has achieved profitability and strong revenue growth, its current growth rate may not justify the lofty valuation. Some analysts argue that the company's forward growth prospects are already reflected in the price, and any slowdown could trigger a sell-off. And then there's debt and financial leverage, right? Robinhood's debt stood at $9.1 billion at the end of the most recent quarter, a notable figure relative to its $64 billion market cap. High leverage can amplify downside costs, okay, especially if the market conditions deteriorate or if the company faces unexpected costs from acquisitions or regulatory fines. The third stock is, it has weak growth and negative earnings outlook, right? So Dillard's has experienced declining demand, with same-store sales dropping an average of 3.8% annually over the past 2 years. Analysts forecast a 2.4% decline in revenue over the next year following 5 years of flat sales. Basically earnings are projected to decrease by 24% per year for the next 3 years, while the broader market expects 10% annual growth. The company's PE ratio remains low, reflecting limited growth expectations and underperformance compared to peers. Negative analysts, they out there, right? And they have sentiment and downgrades. So the consensus among 12 analysts in a sell rating, with 42% recommending sell or strong sell and no analyst recommending a strong buy. UBS, while raising its price target to $200, maintains a sell rating, citing concerns about the declining market share and ongoing gross margin pressures, right? Analyst price targets range widely, but even the higher targets are well below recent trading levels, suggesting limited upside. There's recent financial and stock performance concerns as well. So Dillard's revenue for FY 2025 fell 4.1% year over year, and projections indicate further average annual declines of 2% over the next 3 years. The stock has been volatile, with recent 7.7% drop to $359, underperforming the S&P 500 over the same period. There are technical indicators that show mixed signals, so a sell signal was triggered from a recent pivot top, and the stock has fallen 4.48% since then. There is also basically a divergence between rising prices and falling volume, which can be an early warning of potential reversal. There's competitive and sector risks, so Dillard's is losing market share to competitors, and its operational performance is expected to be in line with, but not exceed, market expectations. The U.S. multi-line retail sector is anticipated to grow by 9.2% annually, while Dillard's is predicted to shrink, highlighting its underperformance relative to its peers, okay? So another stock that's a notable mention that you want to look into to probably sell a growth stock is Broadcom, okay? Because it's basically trading near a 52-week high. But that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you appreciate this video and you want more videos like this, please let me know that by hitting that subscribe button and that like button right now. I appreciate your viewership. Stay safe and see you on the next video.